breaking up traditional asset allocation buckets, moving away from broad allocations to public equities and bonds. That's according to a note that was passed around today. Quote, these old assumptions do not reflect the new regime we're in, one where major central banks are hiking interest rates into recession to try and bring inflation down. What do we think, Mr. Josh Brown?
So I want to be very careful about the way I respond to this, but I think it's important to point out you can give someone a 60-40 portfolio right now where they pay 3 basis points for the 60 part and maybe 2 basis points for the 40 part. By the S&P, basically it's free. By the Barclays Aggregate Bond Index, basically it's free. Wall Street doesn't make any money from 60-40 portfolio. Wall Street makes all of its money convincing people that that's not going to work, or it's not going to be enough, or it's not going to do the trick in a specific environment. And Wall Street wants to sell you alts. And I don't have a problem with alts, by the way, but just understand something. That is where the money is made. And so you will frequently hear, quote, the death of the 60-40, and then right before or right after, there's a pitch for something that costs 2 and 20, 1 and 10, whatever the case may be. So again, nothing wrong with alts, nothing wrong with not particularly being enamored of the current bond yield or the current S&P multiple. Just understand there is always a motivation anytime somebody tells you so-and-so is dead, such and such cheap, easily repeatable investment strategy is dead. And I would tell you right now, if you can tell me there's a category of alts that's going to do better than the 5% that I can give you in a short-term bond index, and you say over the next 5 years, you buy a bond starting point right now, buy Treasury, even if you have to roll it at a lower yield, if you tell me there is an alt category that's going to beat that, I'm happy to make a bet. We'll go out to lunch. Please don't send me emails. Actually, I shouldn't have done this. But just my point is, the 5% yielding Treasury is the alt at this point. And not only is this not a great call long term, actually the timing of this is terrible. Should have said it last year. Should have said it 2 years ago. Right now, I think it's very compelling that you're getting some kind of return on the bond portion of your portfolio. For 10 years, the only reason to own bonds was stability. Now, actually, you're getting paid something, and I think that's why, actually, it's a great time for a 60-40 portfolio. Maybe not in the next 6 months, but over the next 5 to 10 years, it's probably a better strategy than chasing all sorts of alternative beta and alpha strategies that are unproven.
Okay, so now to your point, the so-called 60-40 portfolio is up 6.3% year to date. It was, to your point, terrible last year, down 17%. It also is, to your point, over the longer term, up 11% on average between 09 and 21. Now, that obviously was a different environment where money was raining down from the heavens for that entire period of time. Now, Stephanie Link, what's your take?
I don't know why they had to make this declaration, to be to with you. And
I just told you why.
60. Well, whatever. They didn't need to make this declaration. I mean, and 60-40 isn't for everyone. Maybe it's 70-30.
No, but
maybe it's 90-10.
Right.
I understand that, but the sales pitch on 60-40 forever was that it was for everyone.
Well,
no. Younger people should not be in a 60-40.
Absolutely, right, absolutely.
You and I agree on that.
And if you look at the returns 60-40 over longer periods of time, it's about 6.1%. That's not actually so bad, especially when you think about what a horrific year last year was for both equities and fixed income. I actually think, yes, fine, you can own private markets, you can own alternatives, but they're very long duration assets. They're very illiquid. You got to know what you own, and so maybe you'll have 5 or 10% of your portfolio in alternatives in private markets. That makes sense to me. Right. But why would you ever abandon equities when the long-term average total return is about 9%, and in fixed income it's about 6%? You average that in, and you can kind of sleep at night.
I want to hear from both of you guys who are managing money for people too.
Yeah.
Jason Snipe.
For me, I mean, when I look at this story, I look at the once-in-a-lifetime event, which we had in COVID, right? So it blows up the fixed income market. And I think Josh made a good point earlier. I mean, it was relatively uninvestable for the last 10 years, right? Now there's yields. This is an income strategy for our clients. So a 60-40 mix is good for our mid to late retirement folks that are looking to stay involved in the equity market, but also buy the index on the aggregate bond indexes, which I think works in a lot of ways. So For me, I don't agree. I don't think that the 60-40 mix is dead. I think it's indicative of what we've just seen. And I also think this is assuming that inflation still runs rampant, and that won't be the case.
Jimmy.
Scotty, I go back 25 years in this business and obviously more with my family. But what I remember from 1998 was offering people 5% tax-free municipal bonds, investment grade. And people were like, what? I can get 25% in the stock market and you're offering me 5%? Yep. We're back to where yield matters. What BlackRock is talking about, besides what Josh is talking about, which is accurate, is this breakdown that the correlations are going to come together, bonds and stocks are going to go down together. Maybe that's true. But now you can invest in bonds for yield. That is a beautiful thing that I have missed for 15 years.